Hey everybody, welcome back to the show. Hope you're having a good night. Today is our live Q&A. So as always, if you can give me a thumbs up and let me know that you can hear me. And I'm already seeing, let's see if I can find the chat. Come on, chat. By the way, I can see the chat over here, but I can't see it over here. And this is, I want to hit refresh, but it could just blow everything up. I want to hit refresh. I might blow everything up and I'd have to go start all over again. No, I won't do that. I'm going to have to talk to these people. All right. Well, I can see the chat. I just got to look over here and I see the thumbs up. So I'll forget my technical difficulties, as frustrating as that is, and get right to the main topic. By the way, I played in the chess tournament that I want to tell you about because I'm pretty excited. But I'll get to the Boldin thing first. So for those of you, and maybe I should pull up Boldin, just so for those of you who aren't familiar. By the way, if this is your first time watching, I do like a little 5-minute spiel on some topic. Today it happens to be Monte Carlo simulations in a retirement planning tool called Boldin. And then you guys ask me questions. And so the majority of the show is you asking me questions and me doing my best to answer them. I'm not a financial planner, by the way. I'm just a guy with a basement and a camera and a YouTube channel. Let's keep that in mind. All right, so this is Boldin. This is a demo account. And so if we go to the overview, are we in the overview? Yeah, they changed these things. Oh, I guess this is the new, well, that's net worth. So, you know, I have to keep up. Oh, new, more accurate Monte Carlo projection. Has your score changed? Learn more. And they have an article. Monte Carlo simulations, we can think of, there's really a couple ways you can simulate a retirement plan. One would be to say, okay, let's just use historical data. That's what Bill Bingham did with his 4% paper. Let's just look at how investments actually turned out, you know, over some period of time. You could pick multiple periods of time and look at real inflation data. And that's actually an extremely valuable way to look at, to run a simulation. And I'll talk a little bit more about that in a second. But one downside would be, well, yeah, that was history, but history probably not going to repeat itself, you know, exactly the same way. And so couldn't we run a simulation in some way that maybe looks at different returns and different sequences of returns and inflation? And so that's where Monte Carlo simulation comes in. And you just use a computer program. You can actually do this in Excel, but not that I ever have, but I know you can. But and it'll run simulations. Now you need to give it some inputs, right? We can't just give it no inputs and say just assume some rate of return. They might assume 2,000% gain in 1 year, right? Or a loss of, well, you can't lose more than 100%. But in any event, so we give it some average rate of return, and then we give them some measure of how much that return fluctuates from year to year. Standard deviation is the term. And then the computer says, okay, got it. So that's the average, and I understand the standard deviation, so I'm going to vary the returns or inflation. You can do the same thing with inflation over in that range. And it just starts making random variations. And in the case of Boldin, it'll do 1,000 of them. And we can see it down here in Monte Carlo. And there's different settings, and it runs these simulations. And you get a chance of success. In this demo, it's 73%. And I don't know what my assumptions are, average, using today's dollars. Well, this doesn't affect it, but average does. So Boldin announced recently that they made some changes to how they were calculating chance of success. And they made 3 changes. I'll actually start with the bottom one. They changed some of the standard deviations they were using, which is important. The greater the standard deviation, that gives you more volatility. And volatility, all other things being equal, lowers returns, right? And to understand that, by the way, I'll explain why that is. But in terms of changing standard deviation, it makes sense to change it from time to time, right? If you ask me, well, what's the standard deviation, the volatility In the S&P 500, I would say, well, over what time period? It changes all the time. Do you look at the last 3 years, the last 5 years, the last 20 years? You're going to get a different answer. And I don't know I don't know how they set it. And that's where I really want more transparency from all of the retirement planners. I'll talk about that in a second. Not that, by the way, if they share details, I would necessarily say, oh, well, that's wrong. I mean, part of it's just judgment, right? But they did change some standard deviations. And, I mentioned that the greater the standard deviation, the lower the returns. That gets us, I'll come back to this one in a minute, but that gets us here, and I want to talk about this. They were using what's called compound annual growth rate, which is effectively the number you put into Boldin. So if we go back to Boldin, we go to assets, we pick a 401k, and what do I have in here? I have 8.49%. So they would say, okay, that's they're assuming that we put in compound annual growth rate, which we probably are, even if you never heard of the term and didn't think about it. You're trying to put in what your investment. We say it's an S&P 500. You use some tool to look up its average. I'm using that term loosely. Return in the world of investing. If you go to a mutual fund like VOO, which is Vanguard's S&P 500, and we can do that. Let me actually pull it up, because this is important. If we go to VOO, and I'll pull up Vanguard's site here and show it to you, and they're going to show us some measure of its returns over some period of time. If we go to performance, here it is. And so, like when we look at the 10-year performance, they are showing you that 13.6. Let me move it up a bit. There you go. That's compound annual growth rate. That's sort of the industry standard. And so what is compound annual growth rate? Well, one way to think about it is, let's say we invested $100 for 2 years. And in the first year, it earned 10%. And in the second year, it lost 10%. What do we have at the end of 2 years? Well, one way to calculate that is we could say, okay, let's just just use averages, the things we calculated in grade school. So we were plus 10% one year, minus 10% the other. That you can add those two numbers together, you get 0. You divide by, in this case, the number of years, 2. And 0, you can divide 0 by 2. You can't do 2 divided by 0, at least that's what I'm told. 0 divided by 2 is 0. That's the mathematical mean, right? The average annual growth, the average annual, not compound, just average. And so you would think, all right, I'm left with $100. Well, it turns out you wouldn't be. Why? Because when you look at investment returns, 1 year affects then the next, right? So in the first year, you're up 10%. So what do you have? Well, you have $110. And now when you factor in that minus 10%, you're factoring it into that new number, that 110, and 10% of 110 is 11. So you lose $11 in year 2, you're left with $99, okay? And we could make that number bigger if we said, well, let's do plus 20 and minus 20, right? I don't know if I can do this math in my head. What's 20% of 100? I can do that. That's 120. What's 20% of 120? Well, 10% is 12 times 2 is 24. I think I got this right. $96. We could keep going. The more volatile we make this 2-year hypothetical investment, the lower and the lower and the lower we go when using compound annual growth rate. Again, the arithmetic mean, I don't know why I'm doing my hands like this. Anyway, the average is still 0, right? But compound annual growth rate, more volatility reduces your actual, the actual money in your account, which is what we care about. So one could say, okay, well, wait a minute. If the industry uses compound annual growth rate, why is, and we'll go back to it here. Let me show it to you. Why are we even talking about it here? Average annual growth rate. If the industry doesn't use that, why has Boldin started to use it in their Monte Carlo simulation? Well, here's why. And by the way, that is sort of the industry standard. Remember, with compound annual growth rate, as I kind of demonstrated in that somewhat goofy 2-year hypothetical, it factors in volatility for us, right? You sort of the ups and downs. You take 1 year at a time, and it affects the next year. It's got compound annual growth rate. You could think of it as just the plain old average that we're used to calculating in grade school, with volatility factored in. That's compound annual growth rate. And you say, well, right, and that's important in retirement, sequence of returns, risk, and all that. We want that, right? Well, we do, except when you're running a Monte Carlo simulation, the simulation itself is providing the volatility for us by picking different returns each year, up 20% one year, down 10% the next, up 7, down 20, right? It's the whole point of the simulation is to introduce the volatility for us. So we don't need that volatility to be baked into our return number, right? And in some ways, using compound annual growth rate sort of puts the volatility in twice, once through compound annual growth rate, and then once you feed it through the simulation. And that's why average annual growth rate is typically used. Now, the net effect of that, because compound annual growth rate is always lower, unless there was zero volatility, in which case they're the same. Compound annual growth rate is never more than just your regular mathematical average. But assuming any level of volatility, it's going to be lower. So if we switch to AAGR, average annual growth rate, it would actually increase the assumed rate of return. That should help us, right? That unless I'm misunderstanding something about the way Boldin is doing it, that should not reduce your chance of success. Okay. Now, and I think there was some talk about, well, maybe the compound annual growth rate is a more conservative approach. I don't really buy that. I'm all for being conservative with assumptions, but we should know what those assumptions are, right? We, the users, should know when we're being conservative, because there's a downside to being conservative. You can be too conservative and work 5 years longer than you needed to, or spend a lot less in retirement than you needed to. So that's, I tend to lean on the conservative side, but there's a downside to it, and I want to know about it. So I'm glad they've sort of shared all this with us. So that raises the question for those of you who saw your chance of success drop by a lot. Why? My best guess, and go back to the screen here, is it has to do with how they're treating the different accounts. So if we go back to this hypothetical test account, it's only got, I guess, well, checking account, but three investment accounts, right? You might have, in my personal version of this, I don't even know how many we have, a dozen maybe. But the way they used to do it is when they ran the simulation, they ran each account independently of the others. All right. So for example, in year one, even if we assume the same rate of return, so let's take these two here, the Roth IRA and the brokerage account, they're both assuming 8% return, but this one could actually be up 10% and this one could be down 7%. So they were very independent of one another. They still use whatever assumption we put in here, 8%, and the standard deviation that Boldin assigned to that 8% return number, but they ran the simulations separately. Now what they do is they run them all as a group. I will be honest with you at this point, I haven't decided which one I think is better. I think it could honestly depend on your specific circumstances. And it also raises a bunch of questions for me. For example, what if in this 401k up here, I had primarily fixed income, and in the Roth, I had primarily stocks. Now that should be reflected in my assumed rate of return. So maybe stocks, I have 8%, and bonds, I have whatever, 4%. But those should not be highly correlated with one another. And in fact, there should be times, hopefully, you want your investments to always go up. It doesn't work that way, right? So hopefully when stocks are down, bonds are up. That's usually the case. I understand 2022 is an exception, but I'm not sure how that works in the context of Boldin right now, in part because they have absolutely no visibility into the type of assets we have in these accounts. So that's a question I have. Now, Boldin reached out to me. I've had some back and forth. What am I going to do to try to get answers for folks? Is I'm going to do a couple, well, primarily one thing is, and I've already reached out to the folks at Prelana, and I'm going to reach out to Kyle, who's the founder of Projection Lab, and I'm going to invite them all onto the show. Prelana has already agreed. Stuart has been great. We just have to figure out a time. Steve, the founder of Boldin, reached out to me. I've been traveling because at Chesterman, I haven't gotten back to him yet, but I'm going to find out who's the technical expert at Boldin and see if they'll come on the show. So, because I want answers beyond just the specific changes and chance of success for Boldin with these changes. I'd really like to know, what are the assumptions you're making? What are the pros and cons? How are you making them? Is all of this information available online? And so that's what I'm going to be doing. I do suspect that for most people, the changes Boldin made will not significantly change your chance of success. That is just that's just a guesstimate on my part. But I do know from folks online and whatnot that it has changed some folks' chance of success quite a lot. I think 15, 20%. And that I really don't understand. And so I'm hoping Boldin can help me understand that. I will say, so I know I don't have a lot of answers for you tonight. I've sort of explained as best I can what the changes were and why they might impact chance of success. But I wanted to share that plus what I'm going to be doing to get you guys some more answers. One thing I will say, and this is something Boldin doesn't do right now, and I hope they change this. Projection Lab does, Prelana does, and that is allow you to run simulations. I don't think Boldin does this, using historical data. I think the Monte Carlo simulation is important too. But I think it's really important to be able to look at your chance of success through a historical lens, which of course is what it is. There's no assumptions being made. We have the data, right? So we don't have to assume an average rate of return and a standard deviation and all that. And so it'd be nice. I don't know if Boldin has plans to add that, but I hope they do. And by the way, some studies, and there's one in particular that I think was published on Kitz's site, but I may have that wrong, that actually says historical simulations have proven, they went back and sort of went back in time and sort of back tested different ways to simulate chance of success. And they actually found historical simulations to be one of the best. Now, that could be a little bit of self-fulfilling prophecy. I don't know. The other one that they found really good was Monte Carlo simulations based on regimes. Think of interest rate regimes, high rates, low rates, high inflation, low inflation. But all of that gets to the point where you realize there's a gazillion different ways to run and design a Monte Carlo simulation. And so, yeah, at the end of the day, I'm going to try to get you more answers. I'll do the best I can. And that's what I have for you. Yeah, not all the answers yet, but we'll get there. All right. So I don't have, again, I'm going to be reaching out to Restream to find out why this seems to be a problem. I'm afraid if I hit refresh, it'll end the stream. I don't want that to happen. So I can't show you the questions on the screen tonight, but I look at this, by the way. This is what I see. Whoops. There we go. So I see all your questions here. If you put @RobBurger, it shows up in that bright orange. So I can just, let's see, like I can skip all of this, right? Something's on fire. I don't know what, I hope everything's okay. Anyway, those are the thumbs up. See, I see the orange. So hit, do @RobBurger if you want me to look at your comment. Oh, real quick. So I played in the World Chess Open, and it was in Philly, 5 days, 9 games. You get a point if you win, a half a point if you draw, nothing if you lose. I lose my first 2 games. I mean, I folded like a lawn chair, and I was really bummed. But, and toast to me, I went on to win game 3, 4, 5, 6, 7, 8, and 9. Tied for second, won a big prize. My rating was like near 2,000 forever, and then it just took a nosedive over the last few years and was like 1837. But after the outing this past weekend, it's back into the 1900s. So I got that going for me. At the end of the stream, I'm going to show you. We're going to talk. For those interested, we're going to look at this position from one of my games and this position, and I'm going to see if you can guess the right move. But I'll do that at the end, and that way, for those of you who are like, Rob, I don't really care about chess, you don't have to watch it. All right, let's get started. Again, can't show you the questions on the screen, but that's okay. Keith, what are the demographics for your channel? I'm on the younger side. I'm 35 next month. Yeah, you're young. My demographics do skew towards the 50 and older. That is certainly true, and I guess that kind of makes sense. But I'm glad I welcome I welcome the kids. Come on, everyone's welcome. By the way, let me show you something that I think you guys will like. If I can find it real quick. Something I hope to have it live next week. I mentioned this in the newsletter. If you haven't subscribed to it yet, you can do so. There's a link below the video. It's a free newsletter I send out every Sunday morning. I have I own this. Like if you can own a subreddit, I guess I don't technically own it, but do it yourself retirement. Now this is not publicly available. If you try to go to the URL, you won't get there. I just put this test post in there, but I'm launching this next week. By the way, there won't be much to it when I launch it. I'm going to just put up some community rules, and but this is going to be a place. I was thinking, I get a ton of email, and I read every email I do, but it can take me a while. I mean, I probably get 1 to 200 emails every week, and they're like, some of them are chunky, and way back when I had the Door Roller Money podcast, I created a Facebook group to basically do the same thing, and where people could ask questions, have discussions, people could help other people. And so, we're going to do this on Reddit and see how it goes. Yeah, see if it works. So I'll launch that probably. I'll launch it. I'll launch it by next Sunday, no matter what it looks like, even if it still looks like it does now. All right. Hopefully that'll be a fun place to hang out. Let's get back to the questions. This is from Kelly, assuming one is not able to contribute new money from income, does it make sense to max out Roth IRA by selling in a taxable account, particularly if long-term gains? So you got to have the earnings, but it sounds like you do have the earnings. You just can't free up money from your earnings to contribute to the Roth. That's a great question. Would the benefits? It's kind of like a Roth conversion. I mean, it's not a Roth conversion, right? Because you're taking taxable account money, but it's kind of like a Roth conversion in the sense that to sell the investments. I wonder, can you move investments in kind from? You probably can't. I'm going to say you can't, but I don't know that. But I'm going to assume you can't. But it's kind of like, you do a traditional to a Roth, you trigger taxes on 100% of the conversion as ordinary income. If you sell investments that have long-term capital gains in a taxable account, one, not every dollar is going to be taxable, just your gain, right? And it's taxed at long-term capital gains rates, assuming you meet all the rules. And so that's better. And so, yeah, I could see that making sense. I think, though, before I pulled the trigger, I might do a little research on it. I confess I've never considered that question. But some things I would think about. If I don't do this, when will I spend that money that's in a taxable account? For example, is there a possibility that I'd never spend it and my kids would inherit it and get a step up in basis, or I'd give it to charity? That might be relevant. You are triggering the taxes now. I mean, in a traditional Roth conversion, you've got this, say a traditional IRA that eventually you're going to have to pay taxes on, right? RMDs kick in, or even if you die and it's still there, and eventually, unless it's a charity, say your kids inherit it, they're going to pay taxes over 10 years or whatever. Of course, with a taxable account, if you're going, you're never forced, right, to sell in a taxable account. There are no RMDs, required minimum distributions, for a taxable account. But as a practical matter, you could look at this and say, no, but I am going to sell it to live on in retirement. At some point, I'm going to trigger the taxes. It could be not a bad move. But I would noodle around on that more. My confidence level in my answer is not great. All right. Dave wants to know if I had a good fourth. I had a great fourth. I was playing chess on the fourth. But I went on the fourth. The first two games I lost. The second game was a disaster. I moved my queen to a square. Didn't have to move it there. I voluntarily moved my queen to a square that allowed someone 200 points lower than me to fork my queen and rook. So, of course, I moved my queen. They took my rook. I took their knight. That's called an exchange sack, although it wasn't even a sack. I mean, an exchange sack would be when I intentionally give up a rook for a knight or bishop. She just took it and said, thank you. And what makes it even worse is later in the game, I actually had a move not that hard to find, in my opinion, that I would have allowed me to draw, and I missed it. I was really bummed out after game two. Anyway, enough about chess. So Rob wants to know, how often and when do the Vanguard Target Date funds rebalance? So I actually tried to find an answer to this question not that long ago, and I never could find a definitive answer. But the best I could conclude is it's regularly. I mean, almost continuously. I mean, I don't know if daily, but let me see. See if we can get an answer. So here's an article. This may have been the article I read. Seems like it's right on point, right? Because they have to be, their target date funds are tracking indexes, and then so they're gonna keep track of the index. Although index-based TDFs are not index funds. That's interesting. So they must hold individual securities, but that mirror the index. Yeah, this is what I remember. It's like portfolios are rebalanced at predetermined time intervals, such as monthly or quarterly. Okay, well, which is it, and does it change from fund to fund? It was almost like this was a theoretical paper. What I didn't do, and you might try, is to go into the prospectus of the fund and see if, let me see something, Vanguard Target Date Funds Prospectus. See if we can pull one up. Here we go. We'll just pick the 2070 for you kids out there. Here we are. Fund. So the way you'd find it, by the way, this is the 2070 fund. You've got fund literature. And then you get this link here, and they have a summary prospectus, statutory prospectus, which is like the full thing, statement of additional information. I don't think it would be in there. The short answer is I don't know. Let's see here. So what I think I actually did this, and I didn't find anything. Let's see. Rebalance is mentioned once right here. Let's see. Each fund will use features to both facilitate the periodic rebalancing. Yeah, I did do this, and I got that answer. I find that very unsatisfactory. And I don't think it's going to be in the statement. It shouldn't be in here. But maybe I'm wrong. I didn't check this one. Maybe I should have checked this one. Rebalance, none, zero. So I suppose you could try to I can't imagine, by the way, if you just called up Vanguard, one of the reps, I'd be stunned if they know the answer. It's just, but I kind of stopped there. That was my research. I did this just a couple of weeks ago, or a month ago. Yeah. Maybe there's a definitive answer out there. You might search the Boglehead forums, because the folks they're the kind of folks who will know the answer to this. If any of them happen to be watching, they're probably yelling at the screen now saying, Rob, here's the answer. But I can't hear them yell. So, all right. What do we got next? This is from Josh. Have you read Professor McQuarrie's article, The Widow Tax Hit Debunked? I'll pull this up on the screen. I'm curious. I know that name. I've read papers that he's written. I'll have to look. But here's the paper. I don't recall reading this. Let me drop a link to this in the chat. There you go. Whoops. I'm reading this real quick. Well, I have to read the paper. For retired couples receiving Social Security and Medicare, the dollar tax hit incurred when the survivor enters the single brackets is likely to be inconsequential. Fear of the widow tax hit stems from a myopic focus on tax rates combined with the neglect of changes in expenditure that must also follow the first passing. Well, I mean, it'd be interesting. I'll read this paper later. And that could be true for many people, but I could also see that being, well, I know that's not true for some people. I get emails from them and they get clobbered. So I'll read the paper. It's interesting. I don't recall reading it. But where I hear it the most is with the RMDs. And that's where I think Roth conversion planning can help. At the end of the day, Roth conversions I think can be smart, but this is something Mike Piper said at a Bogleheads conference, and I tend to agree with it. Most of the time, it's not going to move the needle a huge amount. I think for me, part of the appeal to a Roth conversion, and I've not really done any other than the backdoor Roth. I'm going to be doing some this year. And we'll see how much we can convert over time, but it's just going to simplify planning. It'll simplify things for my wife if I should go first. So I think there are other factors. But when a spouse dies, it's certainly true, presumably, that expenses will go down, but so does income. And your income could go down and your taxes could go up. Your income's going to go down, presumably because of Social Security. Well, it definitely would, if assuming you're both receiving it. You're not going to continue to get two checks, right? Like I have a relative whose a spouse passed away recently, and so she'll get now 50% of his pension. Right now, of course, that's going to reduce taxes, but the net effect is not good. So maybe when it's all said and done, for a lot of people, the widow's penalty is not a big deal. But again, these sort of broad statements, they may help you focus, zero in on the issues, but you've got to think through this for yourself. Every situation is different, right? Okay. What's next? Rob, how to use James Sandage's momentum ratio and its value to prevent the death spiral. So I'll show you what that is. And I'm going to do, if it's what I think it is, I'm pretty sure I remember this because I think it just came up. Someone emailed me about it. I don't think I can copy this, can I? No. That's okay. I'll show you this on the screen here. Let's see here. The death spiral. Here's the article. Let's get rid of the shoes. The death spiral is basically, when you could think of the death spiral when, because of poor investment returns and high inflation, you start spending a lot more money, and it becomes clear that if you keep going at this pace, your plan's going to fail, right? And this is not the specific article that I had in mind, but I think he wrote the article that I have in mind. But in any event, let me drop a link to this in the chat. One of the questions, I think the big question is, what are the warning signs? What are the red flags to be looking for that may give us an indication that our plan might fail? What are the canaries in the coal mine, right? And so I am going to do a video on that. In fact, let me see. Bear with me while I check my notes. I didn't put it in my notes. I actually have a place for a task for that video. And so I will do that shortly. So I'll look at this article. There's a more detailed article that lists out things you could be looking for, right? Well, one of them would be your withdrawal percentage. Even if you're following some inflation adjusted withdrawal distribution plan, not unlike the 4% rule, where you start with a percentage to get the ball rolling, but then you just adjust last year's spending by a rate of inflation. By the way, I'm guessing most people don't actually do that. They spend what they need to spend. And it's probably not that much different than the year before, unless there's some event that happens in your life. But it's worth saying, okay, whatever I spend, what percentage of my savings that I have to take out that year. And, if it starts to get too high, that could be a red flag. Of course, then that raises the question, well, what's too high? And certainly when you get up into around 7, 8, 9%, unless you're 97, it can start to be a red flag. But that's just one example, and I will do a video on that. By the way, it's another reason just to keep a retirement planning tool of your choice, and look at your assumptions every year and your chance of success, as we talked about, which is not a perfect measure, but I still think it's quite valuable. I will do that video. Keith wants to know what I think about his asset allocation for his HSA. I think it's too complicated. Let's see here. 50% VEA. Is VEA emerging markets? I can't remember. No, not even close. Oh, it's international. So why do you have a tax managed fund in a HSA? Is it tax managed? That's what it says. VEA. Let's see. That's what Google said. Maybe it's not tax managed. Anyway, you have that. I'll just leave this on the screen so everyone can see. What do we got here? Well, it's tiny print, but 15% AVDV, 30% VWO. VWO, that's emerging markets, right? Yes. Emerging markets. I mean, it's for me, it's kind of a involved portfolio. These are all good funds, 20% SCHD, 20% VN. Is that long-term? What's VN? Long-term bonds? All these tickers, I can't remember them. Oh, no, really? No, that's VNQ. I wonder if you meant VNQ. I don't see a ticker VN. Anyway, it's stock heavy, which probably makes sense for HSA. It is, a lot to juggle. I can't, but I mean, if you want to juggle that many funds, they all seem reasonable. I mean, if I were going to do like a full analysis, I would figure out what the asset allocation is in the HSA, but more importantly, I would figure out how it affects your overall asset allocation. Now, given that it's an HSA, it may be a really small part of your portfolio, so it's not going to really influence your overall asset allocation a lot, or maybe it does. In our case, it's relatively very, very small. It's, I don't know, 0.5%, less than that. So, maybe that doesn't matter as much. But it looks like you've just basically got a pretty well diversified portfolio of equities. You have AVDV. So we've looked at that a long time ago, I think, which is international small cap. Here it is. You don't need my location. Why do you need my location? I don't want to give you my location. All right, I'm in Denmark. They don't believe me. They won't let me accept. Okay, I would not invest in. Okay, here we go. And we don't get the thing we wanted. All right, well, here it is. It's a well diversified group of stocks. I didn't see any. Did I see any U.S. stocks in there? It's all international. Oh, it's SCHD. That's Schwab's dividend fund. So that's U.S. Yeah, I mean, it's 1, 2, 3, 4, 5 funds. So for me, that'd probably be more than I personally would want. But long term, you want it to grow. Stock funds. Seems like, a reasonable approach. A new untucked shirt, a solid color. Dave noticed. This has been in the closet a long time. It's actually kind of hot. I almost want to take it off. Can I go t-shirt tonight? I have a t-shirt underneath there. Trust me. I wouldn't take the shirt off if there was nothing underneath it. I don't know why I said that. Okay. I'll see if I can sweat it out. UK. If my plan is to convert all my traditional IRAs and now I'm taking it off. I'm burning up. I don't know why it's so hot in here. Did my wife cut off the air? Are we saving money? If my plan is to convert all my traditional, here, I'll put it on the screen so you don't have to actually watch me take the shirt off. all of my traditional and pre-tax 401k into a Roth IRA in the next 10 years before I start taking Social Security. Once the conversion happens, where would bonds go? All right, how do I look now? It's just a t-shirt. It's much cooler. Well, you'd have to choose whether, I don't know if you have a taxable account, but you'd have to choose one or the other, right? And there, I'd probably, unless they were muni bonds, which I would have in a taxable account, or maybe some short-term spending, I'd put them in the Roth. Asset location is one thing to consider, and I like stocks in the Roth. But sometimes you don't have the choice, right? And to me, it would be more important to have the allocation that I need. That would trump the perfect asset location for me. That'd be my choice. So here's it. Mike wants to know, any chance you could ask the Boldin folks when they will add Social Security, disability, and family benefits into Boldin? It breaks all the other calculations for my family without them. But I wonder, I don't know, I can ask them. I don't know what the answer is. But I wonder, can't you just put those benefits in as like income? I don't know. I'm sure I'm missing something. Maybe there's some tax treatment. Although, I don't know what. So let's assume they're tax-free, right? I don't know if this will help you, but one thing you can do, this may not work at all because I've never dealt with that issue, but I'll just show you this and maybe it'll be helpful. We go to income. This pension option, this is a really important option, even if you don't have a pension. And I'm going to show you why. So let's say, you get some disability benefit. I'm going to assume it's tax-free. Again, that's a big assumption. What do I know about them? I don't. So like I said, I'm just a guy in a basement with a hot basement with a YouTube channel. So we'll pick monthly. We'll say you're currently receiving them, whatever. We'll just say disability benefits. You can't type. You can call it whatever you want, right? And let's just say we'll just put in $100. And it's whatever. Is there a COLA? And is it taxable? No. Let's assume it's not. So the pension is the one place where you can put income that's not taxable. You might do this. I mentioned this in a past video with a real estate investment. You own some rental properties, and maybe because of the depreciation and mortgage expense, you have this cash flow coming in that doesn't trigger any taxes. You could use you could use this pension, quote unquote pension, for the same thing. I don't know if that helps you. Maybe I've misunderstood it, or it's just doesn't work for you. But that's something to think about. Maybe it helps. Hopefully it does. Keith wants to know if I wear Untuckets all day. No, we wear them. I wear them when I'm going out. We don't go out anywhere fancy for the most part. But I'll wear them to go into a nice. We don't go to like fancy restaurants for the most part. But we go to a nicer restaurant or something like that. But no, I don't wear them all day. I wear t-shirts all day. This is what I wear all day. This is what I wore all day from Philly on the train to here. Okay. Jay says, the guys on the Retirement and IRA podcast, I don't think I know that one. Anyway, say that you should use bond ETFs like the iBond ETFs. Now, that's not the government iBonds. It's it was a BlackRock? Anyway, why they named it iBonds. Anyway, iBond ETFs instead of an ETF like BND because of interest rate risk. Well, so you could say the same thing about individual bonds. So here's this is a conversation that will never die. It's like income investing or dividend investing or the bucket strategy. I can buy an individual bond. Let's say I buy a 10-year, it doesn't matter what kind, treasury bond. Or I could use an iBond. I'll show you the iBond ETF. Bullet shares would be the same thing or something similar. Is iBonds BlackRock? Yeah. So I'll pull this up. So here it is. iShares, they named it iBonds. So yeah, whatever. I guess they just wanted to confuse everyone, or at least confuse me. Maybe you guys aren't confused. And so you can look at one, like we go out 10 years, here's 2035. And these are, here we go, 2035. This is a fund that it's an ETF, but it acts like an individual bond in the sense that you can hold it to maturity and you get all your money back. And this fund will dissolve in 2035 and return to you everything, you know, that it has. So bullet shares are the same way. So if you, the first thing to note is an individual bond or an ETF like iBonds absolutely has interest rate risk. The value of the bond, individual bond or bullet shares or iBonds, the value will go up and down over the next 10 years in this example. Now, you can choose not to sell it. And that gives us a sense of control. It does give us control. We decide when to sell, right? But if we have to sell it early, life happens. We might get more or less, depending on what interest rates have done. We could sell it at a premium if interest rates go down. If they go up, we're going to sell it at a discount, right? So it has just as much interest rate risk, you know, individual treasury bond, iBonds, ETF. It's just that it gives you some level of control. With a fund like B&D, it's constantly buying and selling stocks to maintain a certain duration. Think of that as, it's kind of like maturity, not exactly. Around 7 years, it fluctuates. It fluctuates, the duration fluctuates based on the yield actually can affect. They can have the exact same bonds, and if interest rate jumped 5% tomorrow, which would be cataclysmic, but its duration would change just like that. Even if they didn't sell a single bond or buy a single bond, just rates jump 5% tomorrow, duration changes, right? Because duration is a measure of when you're going to get your money back, some of which comes in the form of interest payments. Well, if interest rates are higher, you're getting bigger and bigger payments, so it changes duration. And so a lot of people say, look, don't buy B&D or any other kind of fund like that because it has interest rate risk. Well, yes, but so do bonds. If you have here's my rule of thumb that I follow. If I have a specific need for a specific amount of money on a specific date in the future, I'll probably buy an individual bond or group of bonds, maybe something like an iBond. If I said over the next 5 years, I want some inflation protected bonds to bridge the gap between when I retired and when I'm going to start Social Security, I would build a TIPS ladder, probably. But in terms of just general long-term investing, it's just too much of a hassle and it's unnecessary in my view. B&D is perfectly fine. And sometimes interest rates will go up and the value will go down. When that happens though, as they're buying new bonds, they're getting the benefit of that higher yield. Trust me, if you buy an individual bond or a bond ETF like iBonds and interest rates go up, you can say, you can console yourself by saying, yeah, the value went down, but I'm not going to sell. Fine. But you're getting lower rate than everyone else was getting. And, you know, there's nothing you can do about that. I mean, you could sell and buy a higher rate bond, right? But you're going to have to sell at a discount. And when you buy the higher rate bond, it's going to be a wash, assuming it's the same bond, same duration. There'll have been no benefit. I mean, I guess maybe there could be a tax benefit if you sold the first one at a loss, maybe, I don't know. Yeah, that's my view anyway. What do I know? Okay. Ocean View, great name, wants to know, what do you think about the chance of success score? Helpful, or does it take away from the real data? It seems like people focus too much on the score. Well, I think the score can be a useful way to get a very high level view of your plan. I think, in fact, I was reading, I'm writing, I hope to have it published this week, a very detailed article on the bucket strategy. It's probably going to be at least 5,000 words and I bet it has at least 50, if not 75 or more sources linked to it. Sort of a comprehensive guide on the bucket strategy. And one of the articles I'm trying to think which one it was, but was talking about sort of the framework for how to think about, oh, you know what this was? So let me show you. It's actually in a book. Here it is. I think it was in this book that I bought recently called Plan Your Wealth by Bill Hines. And Bill emailed me. I haven't emailed him back yet, but I will. And I think I'm going to have him on the show. He uses Prelana, and he has a firm that helps people with their retirement plans. I think it may have actually been in this book, but it walks through sort of a way to think through building a retirement plan. And if you think, I don't remember, I think there were 4 stages. I'm not going to remember them all, but you input your data, right? That's step 1. You run an analysis. You get that. You go back to Boldin here. I think he uses Prelana, as I said, but whatever. You go to your tool of choice, and you get some number. And then the third step is you start to refine things, right? Are all my assumptions accurate? As part of that process, you're going to see how this changes. How sensitive is this number to my return assumptions, my longevity assumptions, my inflation rate assumptions, how I'm going to handle long-term care. I mean, on and on and on. And then ultimately, you can begin to run what-if scenarios. Well, what if this happens? What if that happens, right? I think the thing to avoid is to put all your data in, come here, get this number, and then you're done. You're not done. You've just started. When you put all your data in, do the analysis, and you get this number, okay, now you can start. Now you can start building your retirement plan, right? And by the time you've done all of that, tested your assumptions, changed them, run what ifs, do comparisons, you're going to be, I think, less fixated on this specific number, and you're going to have a much better idea of what's affecting your plan, what really matters. Again, none of us can predict the future. We don't have a crystal ball, but I think it can help us prepare as much as we can prepare in this life, right? So that's my take on it. Okay. Tom wants to know, what, if any, are the advantages of owning a basket of individual stocks versus index market funds? Well, there aren't many advantages, in my view, to owning a basket of individual stocks. So there's 2 ways to think about that basket of stocks. You could build a portfolio, a basket of stocks that is intended to mirror the S&P 500 or some other index. You wouldn't have to have, in the case of the S&P 500, 500 stocks. You can probably come close with, I don't know, 25 or 50 maybe. And you could probably track the index pretty well. Well, you could start with 10 and you'd track about a quarter of it, right? Or 30% of it. But probably 25, certainly at 50, I would think you'd be pretty close. But I don't know why you would do that. I suppose if you wanted to engage in some form of tax loss harvesting where you could sell individual stocks and, sell Coke and buy Pepsi to avoid the wash sale and do that sort of thing. There are services that will do that for about 40 basis points. I mean, I think Wealthfront does it. I don't know what their cost is. Fidelity does it. Schwab does it. But you end up with a portfolio in that case that can have hundreds and hundreds of positions, and you end up sort of either wedded to the broker and their fee, or taking over a ridiculously complex portfolio. And I think at the end of the day, you're going to find that the benefits of tax loss harvesting most of the time in that context will go away in a couple of years, because eventually, unless you're adding a lot of money every year, or maybe you have some kind of business things that generate a lot of short-term capital gains every year, you're going to end up, I don't have any losses because all of my investments are long-term. I mean, so the benefits are going to dwindle. And beyond tax loss harvesting, unless you're a stock picker, that's different. But I honestly, I don't see many advantages to owning individual stocks. Some folks like, and I do this, I have the Apple stock has grown, but inside my credit card rewards account at Robinhood, I invest in individual stocks. It's just for fun. But beyond that, our real money, right, is in index funds. Well, and Apple and Berkshire. Berkshire is basically a large cap mutual fund Very inexpensive one. Okay. How are we doing? People still, I haven't asked you any questions. I have a question. Let's see here. I'm going to start a poll. By the way, I watched a video, someone sent it to me, of another YouTuber who said under the, what's the name? I always forget the name of it. The One Big Beautiful Bill. Anyway, that backdoor Roths were going away. And from what I can tell, that's not true. I don't think anything's happening to the backdoor Roth, at least that I've seen. So should I cover the big, beautiful bill in videos this week? And what I mean by that, that's a question, just yes or no to start with. Like I would do, they'd probably be short. I'd be like, what's the effect on Social Security? What's the effect on Affordable Care Act credits? I don't know. I kind of think you guys could easily get that information, just Google it, or I don't know. But I don't mind doing videos on it. I'm not sure that I have anything, particularly noteworthy to say about it, but you know me, I can come up with something to say. All right, where was I? John says, historical backtesting is one of the best, but the starting point matters. Yes, it does. Hence, same as big earn. Not sure what that means. Plus, Boldin has 2 sets of returns for each account. Well, they can. By the way, what they do is they assume the number you've put in there is compound annual growth rate, and there's a formula you can use that comes close to converting that to average annual growth rate that they run against the number. I know Big Earn has his spreadsheet. I mean, to me, you'd want to historical back testing. You'd want to run it against a lot of different years, right? And let me see if I can show that to you. Yeah, so Projection Lab does this. By the way, if you want to try Projection Lab, in my newsletter every Sunday, there's a link and a discount code where you can get 10% off. They don't want me sharing it outside of my newsletter. I don't know why. That sounds like some scheme I'm running to get you to sign up for my newsletter. I promise you it's not. You can sign up, get the code, and then unsubscribe if you want. Anyway, if we go to this is a demo account. I really like the graphics in this, although I like Boldin's stuff too. But in any event, if you go to chance of success, and what's the methodology here? Or, I'm sorry, the data source. So this is a normal distribution, right? So here you see the mean that you can put in yourself. Well, you can do that in Boldin as well, but you can also set the standard deviation. I think for a lot of folks, that might be more trouble than it's worth, but you can always leave the default. But in any event, we can switch this to historical. Now it's just the S&P 500, and I'm guessing your investments are not just S&P 500, but it's something, right? And we can use historical US inflation. So we can put all that in and then run it. And it's doing 96 trials. So, it's not just, it's looking at a lot of different starting points, if you will. And you can see them here. They're all of them. Large surplus, but that I don't know what this is a demo plan. I don't remember the assumptions that I put in. But what I like about this is you can pick one. So 66 was always a hard time to retire. But again, the spending in this demo plan, I think I added a bunch of assets to this plan at one point. Yeah, that's why its chance of success is so good. But you can pick a trial, and it'll show you the actual investment growth rate, dividend that they're assuming for each year. Now, I don't know what one would actually do with this data, but I kind of I feel comforted that it's in here and I can look at it if I want to. But that's an example of historical analysis. Prelana does the same thing. I hope Boldin adds that to their tool. I don't know how hard that is to do, but obviously Projection Lab and Prelana have figured it out. I know the folks at Boldin can do it. There may be reasons they haven't. I don't know. Where am I? Okay, I know where I am. JT wants to know, JTS, what are your thoughts on an employee stock purchase option? My company's stock dropped 40% last week. I'm glad I opted just for the 401k. Again, I wouldn't generally have a heavy concentration in any one company. With employee stock purchase plans, at least when I was in one for, I worked in-house at KPMG Consulting. It later changed its name to Bearing Point before I left, and it went bankrupt. I don't think my leaving caused the bankruptcy. I was part of their ESPP because I got a 15% discount. And then I was in the legal department, so there were restrictions on when we could sell. We had windows. And as soon as the window opened, I just sold it all. And I made my 15% or whatever. So, I think buying company stock can be a good thing, but I wouldn't put all my eggs in one basket. I would keep a well-diversified portfolio. I actually know someone who worked at a company and it wasn't a high-flying tech company or anything, but they basically put everything in the company stock, and it worked out fine for them. So there you go. But it wouldn't be my plan A. All right. So most of you, 75% want me to cover this. So I'll do a video, or maybe I'll just do one video, like top 7 takeaways for retirement and investing. Or I do want to include the ACA. My understanding is, I'm no expert on ACA credits, but that under the Biden administration, they increased the amount of the credits. They called them enhanced in response to COVID, and that those are going away in 26. But I haven't confirmed that. I just read that on the internet. So I'll obviously do some research before I do the video. If they're there for COVID reasons, it kind of makes sense that eventually they'd go away. But of course, that may not make it easier for those that are relying on them. So anyway, all right, I will do a video this week. All right. So what do the competitors of Boldin use to model the retirement results? Average annual growth rate instead of compound annual growth rate. Prelana. Let me see if I can pull up the manual. Yes. I'll show this to you in a second. Here's the Prelana manual. It's only 194 pages. Should we read it together? Page 1. 129. I could have just searched for compound annual growth rate, probably been faster. I'm pretty sure, yeah, here we go. Yeah, they use arithmetic mean. The technically correct way to model market volatility in Monte Carlo simulations is to use the arithmetic, that's how I say it, the math mean, in generating the random numbers for the simulated annual returns. In contrast, the technically correct way to make deterministic projections is geometric mean. So what they mean by that is, if you were just going to take the one rate, you're not going to simulate it with variance at all, just apply one rate and model it, which Boldin does that too, in that view on the, let me see if I can show it to you. It's usually on the overview screen. I think they have done something different with this main screen. Why can't I find, I don't know why I'm not seeing, this is the forecast. Well, this is the forecast of net worth, and it's just using a compound annual growth rate. There's no simulation involved. And if you're just going to assume one number, you would use compound annual growth rate. And that's what they mean here. That's what they call a deterministic projection. It's fancy talk. And then they say Prelana assumes the values entered on the asset classes page are geometric returns. It uses these values in generating its fixed rate projections, right? And along with the corresponding standard deviations, approximates the arithmetic mean for each asset class. And that's what Boldin does now. It's my understanding that's exactly what Boldin does. And there's a simple formula. Well, here it is. Arithmetic mean equals the geometric mean plus standard deviation squared over 2. And that's exactly what Boldin does. And that's I'm not a math. I was an English major. I like math, but I'm pretty sure that's correct. Not that the folks at Prelana need me to tell them that they're correct, or Boldin for that matter. So yeah, that's the deal. Okay. By the way, I'm taking math on Khan Academy. I was simplifying square roots and everything. It was exciting. One thing I'm happy about is my ability to like do multiplication quickly is still pretty good, which comes in handy. You know, advanced math, no, but I can multiply. Michael says, this 32-year-old always appreciates your viewpoints and information. Appreciate it. Okay. Oh, here's an important question. Suggestions for sites to learn how to play and understand chess. I'm interested. So I honestly, one would just be chess.com. You can play for free. You can get the membership's not much. I don't remember what it is, but you can, they have courses, lessons. You can puzzles. I do this puzzle rush. I'm not going to play this. I'll start it just to show you, but you basically have 5 minutes to solve as many problems as you can. And so it does this sort of thing, and you've got to know that's the answer. Then it comes here, and you got to, you just do this for 5 minutes, and it's a good way to learn. I mean, honestly, solving puzzles is probably the best way, to get better. So that's what this is. But they have other kind of puzzles. So this is a really good one. There are more advanced tools that if you're just starting, I probably wouldn't use. Maybe one of them is called Chessable. I'll show you that. I'm logging in. Maybe. So this has sort of advanced, well, they're not all advanced, but they have courses that you can buy. Some are free. This 100 end games you must know, which is considered, particularly for folk, grandmaster, Magnus Carlsen, they had him solving some of these. And it's funny because this, let's pull one up. They have all these rules that you learn. And they were asking Magnus, have you heard of the such and such a rule? And he's like, no, I just know how to play this. So this is black to play, and queen's checking him. He's got a pawn here. Can you draw? Black obviously can't win this, and that's the first answer, because if the queen had taken this pawn, it'd have been stalemate. So anyway, that's a little more advanced, but chess.com really is pretty good. All right. John wants to know, does it seem reasonable to be more in bonds and international for a long position since U.S. stocks are so overvalued for 15 years? My view is that you ought to come up with an asset allocation and basically just stick with it. And at any time, some of the assets are going to be overvalued, undervalued. Some are going to go up, some are going to go down. The problem that I find is you almost get decision fatigue. You're constantly asking about this investment, that investment, what should I do? And it's exhausting after a while. And I found that I'm so wrong. I mean, I was convinced stocks would have gone down 10 years ago. They've been in some ways, they've been overvalued for 40 years. I mean, if we go to the Shiller PE, here it is. So right here, I'm still in high school right here. I mean, some of you weren't even born, 30-year-olds, please. I'm watching Hill Street Blues. Okay, that's what's happening. Great show, by the way. Belker was I love that guy. Anyway, that was the low watermark, right? And of course, what was high at this point? Interest rates, right? Double digits. 82 is when they started to come down. And as they came down, asset prices went way up. But if you think about average, what's the mean? 17. This changes, by the way. So first of all, this is not, you say the mean is 17. There's thousands of means. This just happens to be the mean as measured since 1871. Why don't we measure the mean since 1995? That's 30 years. That's a pretty long time. The mean's going to be something like 30. I'm just looking at the graph. I don't know exactly what it'd be. We obviously took a nosedive during the financial crisis. But I mean, it's been, well above, let's say above 20 since 1992, other than for a couple of years when we had the financial crisis. So, if we'd been in international stocks, I mean, there were some good times to be in them. The first decade of this century, international stocks did better because we had basically two market crashes. But still, I just don't see the Shiller PE as a way to sort of make my investing decisions. And if you're well diversified, the Shiller PE, it certainly doesn't become meaningless. But I've got international, I've got some small cap, both in a small cap fund, but also in a total U.S. stock market fund. And so my PE, I don't know what the PE of my portfolio is. If you want to track that kind of thing, one way to do it, you can do it manually. But Morningstar, Morningstar Investor, is okay. It's not my favorite. Actually, you could probably track it in Stock Rover as well, which is what I use, but I don't use it for that purpose. I just use it for research and whatnot. But yeah, so I think an international exposure is important. And I'm actually slowly bumping mine up because when I switched to a target date fund in my retirement account, it pushed it down a little bit lower. And so I think I'm going to change my Roth accounts from SCHD to VXUS, just because I want to push it back up a little bit. And that's the easiest way to do it. But it's small. It's not moving the needle much, 1% maybe. Okay. How are we doing on time? 8:12. So Stano wants to know, has Boldin updated the program to account for tax rates? I assume they have not yet. I mean, it just happened over, Friday. So I assume none of these have, but they will. And it'll be interesting to see how that affects things. I don't know that. Well, part of the effect, by the way, one thing you can do, you can update this to some extent, at least in Boldin. If we go to rate, is it rate assumptions? Yeah. You can choose between stick with the current rate. This is for after 2025, because remember, the rates were going to expire. So you had a choice between use current tax rates, which are the lower rates, or change to 2017 rates after 2025. And you can see just that one change. Here's what it did, in terms of numbers. Let's see what it did to my percentage. Just 1%. I think it was 73, if I remember correctly. Yeah, just changed it 1%. But again, this is a demo account. Your mileage may vary. So you could make that one change if you were assuming, which was, I guess, the conservative thing to do. If you were assuming rates would go back up, you can change that yourself in Boldin. But I assume it's going to take a couple of weeks. I don't know how long it takes, but it'll take some time. I'm sure it's not a simple thing to do. And for Prelana, I mean, they look at ACA credits. They got to change that. So they're Stewart's busy, for sure. Okay. John mentions that the Boldin weekly email had some info on the Monte Carlo changes. Actually, I can show you that. Let me see if I can pull it up. It's just part of their blog too, I think. Let's see. Maybe. Here we go. I'll drop it in the chat. Yeah. Here was the article, Understanding Boldin's Monte Carlo Simulation. It didn't have details, though, about the simulation. It was just more of an overall, what changed. Well, maybe it's a little more detailed than I remember. This is where they changed average to compound to average. Yeah, so this will be useful. There you go. Jeff wants to know my optimistic and pessimistic settings in Boldin. I don't remember them off the top of my head. I can tell you what I generally do, though. This is, again, not my plan, but I like, so they've made some, I think, improvements to the way to the options you have and the information they give you. This is 849, by the way. This is a demo plan. The reason I've got it set to custom in 849 is because you see the standard deviation down here. I know it's kind of small, but it says 16. Make it a little bigger for you. If we up this by 1 basis point to 850, look what happens. It jumps to 19. That's a huge change for just a 1 basis point change. The new standard deviations they've introduced don't change like that, not that dramatically. And I think I've been told that the engine that runs their Monte Carlo simulation has updated the standard deviations. I just don't think they've been updated in the user interface, but I haven't confirmed that for sure. But in any event, in my actual plan, I just use one of the recommended rates that to me, I tend to put the average at sort of the long-term average, whatever that might be. And it depends on the portfolio. So I probably don't ever use aggressive even for 100% stocks. I tend to probably go a little more conservative, and that's the highest I use is 8.8. There's nothing wrong with using 1025, but I'll tell you why I don't. So if you use 1025, it gives you an optimistic of 12.3, which I guess if 100% stocks, there are certainly times when stocks have returned 12%, but that just seems to me crazy. So at 8 or 8.8, I think that's a reasonable average for stocks long term. And it gives me an optimistic of 10.56, which to me is for an optimistic time period, a little more reasonable. And if I'm concerned about, maybe because valuations are high in the US, we've got debt and whatever, I can model a change, right? So I can say, you know what I'm going to do? I'm going to actually say my stocks are going to really underperform for the first 10 years, 592. But 10 years from now, so 35, doesn't really matter. I'll just pick a date. I'm going to bump it to 8.8. You could run that. I'd probably do that maybe as a scenario and kind of a way to model sequence of returns in a way. But that's what I do. For stocks, it's like 8.8. I have a bond heavy allocation in my traditional IRA, so I think I have it at 664. There's stocks in it as well. So yeah. And you can look, they've got more details here. And then it takes you to this page. And they used to have they have resources here that you can use. And one that I like, well, they've changed it at Vanguard. Let me see what this page looks like. I think this is the right page. Yeah, they model different returns, but they had it actually in a way had it easier than they do now. It's too complicated. But you have resources where you can look at historical rates to use in your running your assumptions. So, yeah. Okay. How are we doing? 10 minutes. Lisa says, I should just, I'm going to do a Boldin live Q&A. Like it'll be during the day. I'll figure it out. I'm traveling a bit, so it's not going to be for probably 2 weeks, but I'm getting a lot of Boldin questions. So we'll do a Boldin, I don't even think of it as a Q&A. It's like we can all just sit around and lament our retirement plan and try to figure out what's best. But my question is about Boldin's calculation of capital gains tax on capital gains distributions. Boldin is returning significant capital gains taxes this year, but it's incorrect. Thoughts? Well, it depends why it's incorrect and how it's incorrect. If you go back here, so this would apply to obviously taxable account, brokerage account. And so the things I would look at, do you have your cost basis here set correctly? That's one. Account turnover rate. So that would be like buying and selling you would do. I have it at 0. This is the demo plan, but in my plan, it's at 0 because I don't trade. But the other thing that could be triggering it is your money flows. Like, is it showing you taking money out of a brokerage account? So if you go to money flows and withdrawal order, the traditional order puts brokerage accounts first. But maybe, again, I don't know what your specific situation is. So I'm just sort of giving you some ideas, but you may have it set to traditional, but you're not taking anything out of your brokerage account, or you're taking things out of your brokerage account that either don't trigger capital gains or have much smaller capital gains than what Boldin is showing. And on that, let me go back to accounts for a moment. Let's say you have one brokerage account with 5 different investments, and you put it all in here as one number and one cost basis and whatever. But those 5 investments probably have their own individual cost basis, right? And when you sell something, you may look at that to decide what to sell. Well, you don't have to map your real accounts one-to-one in Boldin. In fact, in my personal Boldin account, I have a separate brokerage account that represents just Apple stock, right? Why? Well, there's 2 reasons. One is, if we assume this is the amount of my Apple stock, my cost basis is going to be about 200,000. That's about that. My gains are like 80%, which is why we contribute Apple stock to charity when we give to charity. That gain, again, this is just a hypothetical, but it's far greater than other investments I have in the brokerage account. So that's why I separated it out into its own account in Boldin. And then what I can do in money flows, and let me just show you this. Let's just, I'll just be real quick here. Let's add an account. It's a brokerage account. Next. And we'll call it Apple stock. And we'll say it's $1 million. Again, I'm just making up numbers. It's capital gains. And the cost basis is 200. Okay. And let's just save that. What I can do in money flows is withdrawal order. You can see it's right here. It's going to sell at number 3. I can customize it. And the only thing I'm going to change is my Apple stock. Now, again, there's not a lot of accounts in this hypothetical. But what I do is I grab my, you have to hit edit order. I grab my Apple stock and I pulled it last. It's the last thing I want to sell. Now, we contribute some to charity, but other than that, in my retirement plan, look at this. I haven't seen that before. I want it last. And you save it. But I could only do that by breaking this out as its own account, quote unquote account in Boldin. In theory, you could break out all your taxable accounts and taxable investments into separate accounts with their own basis. If you really wanted to, get down to that level of detail, I don't know that that's, for me, I don't think that's necessary, but you could do it. All right. Rick says, following passage of the one big beautiful bill, I get tired of saying that. Although I didn't really care for Inflation Reduction Act either. All the names of these bills is just marketing. Affordable Care Act was marketing. I mean, if you think about the Affordable Care Act, I think there were good things and bad things about it. It was a Medicaid expansion act. That's what it was. I don't know what the one big beautiful bill is. Tax law? I don't know. Anyway. I try to stay out of politics. Following passage of the OBBB and the new 65-year-old deduction, more people are questioning whether to continue Roth conversions. Well, it's just a tax question. I mean, it's a tax question that you've got to make a lot of assumptions with, but it just changes your current tax situation, right? And it might, if you think about it, it's going to lower your taxes now. I mean, it could make Roth conversions more compelling because you can do some more with maybe in lower tax rates, possibly. But it's still just a tax analysis. I don't think, to me, I mean, what is it, a $6,000 deduction? I mean, I don't know how much it's going to move the needle for someone in terms of a Roth conversion analysis. Obviously, it's going to put a fair amount of money back to the folks that qualify for the deduction. But it's just going to become part of the analysis you do. What are your taxes this year versus, say, when RMDs start, right? I don't know for how many people it would actually change what they're doing. It might a little bit. Yeah. Mike says, wonder what you might know of or think about the modeling that Vanguard uses for its advised clients. I believe it's called the VCMM. Yeah, a Vanguard Capital Markets model or something like that. Morningstar has a model too. I don't put much weight into them. I mean, I think the people that put them together are very smart and they do a lot of research and they predict the future, and they're always wrong. Not because they're not good, but because predictions are just wrong. That's what they are. And I don't invest that way. So, I don't know why these companies do that. Maybe someone from that group will come on the show and they could give us a reason why. I just don't find it useful. Just B says, just tell me, is my local hospital going to close? I doubt it, but I don't know. So this is from David. Discuss the implications of asset allocation from a Roth conversion, where in the IRA you had fixed income, but you move that money into a Roth where one's supposed to invest aggressively. Well, again, I think asset allocation comes first. Asset location comes second, in my view. So like if you converted, let's just take an extreme example, you either in a year or over a period of time, you converted all your traditional to Roth and that's all you have. I wouldn't be 100% stocks in retirement just because I had a Roth IRA and that's all I had. That was my only account type. I would have bonds. That'd be my choice. Yeah. Ocean View wants to know if I was surprised by the email that SSA sent out regarding the 65 plus deduction in the BBB. That reminds me of the haircut I got a couple of weeks ago. I've been going to the same guy for a year. He's great. Cuts it quick. And I said, what's your price now? And he said, well, for seniors, it's blah, blah, blah. And I said, really? I said, well, how old do you have to be to qualify for this senior discount? 65. I said, I'm not even 60. He just smiled. He charged me the higher rate. I should have said, oh, great, I'll take the senior discount. So yeah, I didn't get that email. So I was not surprised by it. I think what I've read about it, though, it seemed like it wasn't actually correct. So there's that, but I haven't actually seen it. All right. It's 8:29. So the show's about to end. Okay. I know I don't get to all the questions. I'll try to do some for 5 Question Friday. I do the best I can, but we're going to have this Reddit, this subreddit. We can ask questions there. We can help each other. I'll be contributing. Boy, the hour and a half went by fast. So I will show you these two chess. For those that want to hang out, you can leave. I get it. It's chess after all. Here's the first one. I can see I'm covering up the board. So I'll take myself off. So I was white. It was an interesting game. It's about to end. So I'm white. What's my move? That's the first question. What's my move? I will tell you his last move. Let's see. He did. Yeah. So I moved here. He moved his knight there. and I moved here, and then he moved his pawn to defend this pawn. He could take the pawn here with his queen, right? But then if he did that, I could take this pawn, and so I guess he's defending the pawn, maybe with now renewing the threat to take this pawn. I will tell you the move I played, as soon as he moved b6, which is this move, I knew what I was going to do. I mean, I took a few minutes to think about it, but to me, it just screams out in this position. There is one move for white. You can put your answers in the chat if you want. Let's see if anyone's chatting with. You probably have all left. I'm probably talking to nobody. D7 check. King D7, Rook D5. Okay. That's an interesting idea. Kind of along the lines of what happened. So I took the knight. We call that an exchange sack. Remember, in the game I lost, she took my rook, not because I had a good move. The thing about this move that makes it good is actually removing the knight helps. If you think about this position, I have 5 pieces in play. They're all quite active. They may not look all that active here, but these 3 pieces are eyeing some juicy squares. I got both rooks. Black has 2 rooks that are basically, you might as well just take them off the board. They're irrelevant. But the big thing about this move is, unless he's just going to lose the knight, he's got to use this e6 pawn. And so that allows me to do what on this move? The answer is, and I've been waiting all game to play this move, e6. If we go back in this game, by the way, I made a move that was probably speculative, and it was c4. And he can't allow me to take this pawn because he has to take back with that e6 pawn, and that just would blow open this position. He would have all kinds of trouble. But here we are. I take it, and I push. And it's basically over. He played this. I missed, I think, a pretty neat way to finish this game. I played this, which is a good move. It's enough to win. But I should have taken this pawn. And the reason is wonderful. He can't take here because I fork the king and queen, right? That's out. He can't move here because of the pawn, right? He'd be in check. He can't move here, right, because of the queen. So he's got to move here. And then I can now move the knight. I'm threatening checkmate. And I'm threatening to take the queen, right? So he's only got one. Well, he could move here, but I just take the queen. So he's got to move back here. And I saw all this. I didn't make that move because I saw that he covered the square. But this is the move I missed, attacking the queen. He can't go here because of the knight, here because of the knight and queen, or here because of the pawn. And if he takes this pawn, of course, I just win his queen. So anyway, I would have liked to have finished that way, but the way it worked out was still pretty good. He went back, and then I took here, and I'm threatening mate. I'll show you how it played out. He moved his rook up, tried to get it in the game. So I checked him. He moved here. Now, I have a check. I could play here. This is kind of a cute little arrangement, right? The knight protects the bishop. The queen protects the pawn. But the king could go here, and maybe he gets back here and up in here. So I wanted to take this escape square away from him. So I moved here. And now I'm threatening mate in 1, right? So I don't know. He played a little bit longer. He made this move in an effort to stop the mate. So I just took it, and then he took the knight. But I checked him, and he resigned. What happened? Oh, I guess because the game ended. That was the last move of the game. Yeah, he could move here. Well, I guess because it's the last move of the game. But the next move would have been checkmate. All right, one more, and then I'll call it a night. Is anyone still watching? There's 800 of you still watching. Maybe we should start a chess club. All right, so I'm white. Obviously, it's an end game. I've got an extra pawn, but it's a complicated position. He's got a king, all up in my grill. He's attacking my rook. He's got his rook here in the game, swinging around the back rank. He might swing over here and threaten my pawn, and it's my move. What do I do? And I had seen this position. His king was all the way back here and started marching in. I could see that this was his plan. So I was prepared for this. See if anyone gets this move. Max says, I arrived late. Why are we showing chess moves? The chess club idea is horrible. I'm over here sleeping. Wow. Well, I'll show you the move. By the way, if you just joined, a couple of questions. The show started at 7. Why are you just joining at 8:30? Secondly, you can watch the replay. All right. I've sacked my rook. The winning move is this. And he can't stop the pawns. You just can't. But he took the rook, and I just pushed. And the problem is, of course, his rook can't go here to try to stop it. What he did was he moved here to get his king out of the way. And I moved here. And then he moved here to attack the rook, and I just protected it. And the trick is, when he goes here, I go here. He can take this pawn, but this one queens. He checked me. Boop. He checked me. Boop. He checked me. Boop. Then he took my pawn, and then I queened. And eventually won. I mean, a queen versus rook wins unless there's some weird thing about the position. And that's definitely not the case. He played on a long time. Let me go back. Let's see how many moves I've got in here. We did all this. He really fought. And then he resigned there, I think. It's a fun game. All right. Well, for those that hung out for that, appreciate it. So I will do some videos. I got several that I want to get done, but one of them will be on the One Big Beautiful Bill. And I'll have the subreddit ready next week. So I'll have a link to it in the newsletter. And it can be a place for us to hang out and talk. And I'm going to share, I come across a lot of interesting resources that I just don't have to, there's too many of them to mention. And I can just drop links to them in the subreddit. So I'll do that. I'm working on that long, detailed article on the bucket strategy. So I'll hopefully have that done this week. We'll see. I'm traveling next week, so I got to get it done this week. And I think that's about it. So hope you have had a great 4th. Have a great week. Again, you can sign up for the newsletter with the link below the video. And with that, until next time, remember,